transfer under the demerger, the transfer of any capital asset by the demerged company by the demerged company to the resulting company if the resulting company is an alien company. Section 47(6)(a), Section 47(6)(b), Section 47(6)(b). Now the conversion of the securities, the conversion of the bond debentures, stocks, deposit certificate to the company of the company into the shares or the debentures of the same company into to the share or the debentures of the same company. Section 47(10). Now the cost of the asset of the share, the cost of the asset of the shares debentures received on the conversion is equals to cost of that part of bond debentures deposit certificates which is so converted. Section 49 to a period of holding of the shares debentures shall also include the period for which bond debentures deposit certificate held by the assessee. Now the conversion of the preference shares into the equity shares of the same company. Section 46 10b, Section 47 10, the cost of the acquisition of the equity shares received on the conversion is equals to cost of that part of the preference shares which is so converted. Section 49 to A. Now the conversion, the period of holding of the equity shares shall also include the period for which the preference shares held by the assessee. Section 2 clause 42A, the conversion of the gold into the electronic gold receipt issued by the vault manager, or the conversion of the electronic gold receipt into the gold. Section 47(7)(b). Now the cost of the acquisition of the current asset EGR gold received on the conversion is equals to cost of the earlier asset gold EGR which is converted into the section 49(1). Section 49(10), the period of holding of either asset gold EGR shall also include the period of which the current asset EGR gold held by the assessee. Section 2 clause 42A, the transfer of the sovereign gold bonds issued by the RBI under the sovereign gold bond scheme 2015 by way of the redemption by the assessee being an individual. The transfer of the work of the art, scientific, archaeological manuscripts, books, photographs, or the print to the government, university, national museum, or art gallery, or the archives by any public notified museum. Section 47(9), the transfer of the capital asset under the reverse mortgage under the scheme made and the notified by the central government. Hello Vicky. Hello, welcome guys. Hello guys. Hello everyone. Welcome to the channel. How are you all? Hope you guys are doing well. Why? The transfer of the capital asset under the reverse mortgage under the scheme made by the notified made. And guys, do subscribe the channel. I'm good, Vicky. How are you? You can see it on the channel page. Myself Nandini, and I am a CA Inter student. Guys, do subscribe the channel to stay connected and stay tuned for more content. You can see my page. If you don't subscribe. I am just suggesting to subscribe the channel so that you can stay connected if you want, if you wish. There is no such force. The transfer of the capital asset under the reverse mortgage under the scheme made by the notified by the central government. Section 47 and 16. Now note the amount of the loan either in installment or lump sum received by the senior citizen under the transaction or the reverse mortgage would be exempt from the income tax under section. Then start studying with the effect. Then start studying if you want to be a CA from the income tax under section 1043. Now exempt under the capital gain, exemption under the capital gain, section 54. Section 54 exemptions for the residential house property SSC individual or achieve the transferred assets the residential house property being building and the land up, uh, upper tenant thereto. That's a great thing with you. Right. Now the central government on the transfer asset is equals to long-term capital gain. Now the asset to be acquired one residential house property in India. Note if the long-term capital gain is up to rupees 2 crore, then assessee can acquire two residential house property in the prescribed time limit. This benefit of 2 HP is available only once in the lifetime. Myself Nandini. Guys, do subscribe that channel to stay connected. Now the time limit for the purchase of the construction, the purchase is equals to within 1 year before 2 years after the date of the transfer. That is within 1 year before or 2 year after the within 1 year before or 2 years after the date of the transfer construction complete, I mean individual or HUF. The exemptions for the residential house property being a building or a land upper tenant there to long-term capital gain, the capital gain on the transfer of the capital asset. Long-term capital gain, the asset to be acquired one residential house property in India. Note if the long-term capital gain is up to rupees 2 crore, then the assessee can acquire two residential house property. Thank you. This benefit of 2 HP is available once in a lifetime. Now the time limit for the purchase of the construction purchase within 1 year or 2 years after the date of the transfer. Now the construction within 3 years after the date of the transfer. Now the deposit scheme. Note 1 capital gain CGS the capital gain or the cost of the asset cost of the asset deposit amount, whichever is lower, the amount of the exemption capital gain or the capital gain or the cost of the new asset deposit amount, whichever is lower. If the cost of the new asset exceeds rupees 10 crore, if the cost of the new asset exceeds rupees 10 crore, then the amount exceeding 10 crore shall not be taken into account for the purpose of the exemption set by the Finance Act. To if the cost of the new asset exceeds 10 crore, then the amount exceeding 10 crore shall not be taken into the account for the purpose of exemption. The locking period for the transfer of the new asset transferred within 3 years from the date of the purchase or the construction, then the exemption claim earlier shall be withdrawn and the cost of the acquisition of the new asset reduced by the exempted capital gain while calculating the capital gain on the new asset. Then the exemptions for the urban agricultural land assessee individual or achieve the transferred asset urban agricultural land used by the individual or his parents for agricultural purpose during 2 years before the transfer. Now the capital gain on the transfer of the asset, capital gain, short term capital gain or long term capital gain, the asset to be acquired urban or rural agricultural land. Time limit for the purchase of the consideration, time limit for purchase of construction, the purchase within 2 years after the date of the transfer, 2 years uh, within the date of the transfer. Now deposit scheme CGS applicable, capital gain applicable, capital gain or the cost of the new asset deposit amount, cost of the new asset capital gain or the cost of the new asset capital gain or the cost of the new asset deposit amount, whichever is lower, the locking period on the transfer of the new asset, same as section 54, section 54. The locking period on the transfer of the new asset is the same as section 54. Now the notes: if the assessee acquired a new asset as a rural agricultural land and if he transfers that land within 3 years period, then the exemption claim earlier shall not be withdrawn as the rural agricultural land is not a capital asset. Deduction under section 54B can be for the short term capital gain. Also the conditions is that land should be used by the assessee for his parents for 2 years prior to the date of the transfer. Then the exemptions for the industrial land and building, exemptions for the industrial land and building assessee any person, the transfer asset, the compulsory acquisition of the land or building which was used for the assessee in the business of the industrial undertaking during the years during 2 years prior to the date of the transfer, the capital gain on the transfer of the asset, short-term capital gain or long-term capital gain, the asset to be acquired new land or building for the industrial undertaking then the time limit for the purchase of the construction, the purchase within 3 years from the date of the receipt of the compensation. Then the deposit scheme, CGS applicable, deposit scheme, CGS applicable, capital gain or the CGS capital gain or the cost of the new asset deposit amount, whichever is lower. Now the lock-in period on the transfer of the exemption on the immovable property, exemptions on the immovable property, assessee any person, the transfer asset is equals to land, building or both, capital gain on transfer of the asset is equals to long term capital gain. Then the asset to be acquired, the bonds redeemable after 5 years, issued by the National Highway Authority, Authority of India, National Highway Authority of India, National Highway Authority of India, Rural Electrification Corp Limited, Rural Electrification Corp Limited, Power Finance Corp Limited, and Indian Railway Finance Corporation Limited, Indian Financial Corporation Limited. So NHI Rail, Russell, PFCL, IRFCL, NHI, PFCL, and IRFCL. The maximum exemption limit can being 50 lakhs within the prescribed time limit. Now the time limit for the purchase of the construction purchase within 6 months from the date of the transfer of the original asset, deposit scheme, CGS not applicable, capital gain or the cost of the new asset, whichever is lower, maximum can be 50 lakhs, then the locking period on the transfer of the new asset is transferred or converted into money within 5 years from the date of the acquisition. New then the exempt long term capital gain will be transferred in the year of the transfer conversion. Note, if the assessee takes any loan or the advance on the security of the bonds, he shall be deemed to have converted its money into money on the date of which such loan or advance is taken, and the capital gain exempted earlier shall be taxable. Now section 54F. Section 54F, the exemption for any long-term capital asset other than the residential house property, individual or HUF assessee, individual or HUF transferred asset, any long-term capital asset other than the residential house property, capital gain on the transfer of the asset, long-term capital gain, the asset to be acquired on residential house property in India, the time limit for the purchase of the construction, same as section 54. Now deposit scheme, note 1, the capital gain, CGS applicable. Now the amount of the exemption is equals to long-term capital gain upon long-term capital gain into the cost of the new asset, deposit amount upon net consideration, long-term capital gain into cost of the new asset into deposit amount, long-term capital gain into deposit amount upon the net consideration. Note, if the cost of the new asset exceeds 10 crore, then the amount exceeding 10 crore shall not be taken into account for the purpose of the exemption cited by the Finance Act 2013 with effect from assessment year 24-20. Hello guys, do subscribe the channel to stay connected. Now the lock-in period on the transfer of the new asset transfer within 3 years from the date of the purchase or the construction, then the exemption claim earlier shall be withdrawn and treated as a long-term capital gain. Now the additional condition on the date of the transfer of the long-term capital asset, the assessee should not own more than one residential house property, and should not purchase any other house within 2 years or construct within 3 years after the date of the transfer. If above conditions not satisfied, then the exempt capital gain taxable in the previous year in which such other residential house property is purchased or constructed. Hello guys. Then the capital gain account scheme. The amount if investment under section 54, 54b, 54d, 54f is not made before the date of filing of the return, then the amount of the net consideration in case of the section 54f or the capital gain has to be deposited under the CGS capital gain account scheme. The amount so deposited shall be deemed to be the cost of the new asset. The time limit such deposit in the CGS should be made before the due date or the actual date of filing the return, whichever is earlier. Now the unutilized amount, if the amount deposited in the unutilized is not utilized for the specified purposes within the stipulated period, then the utilized amount shall be charged as the capital gain of the previous year in which the specified period expires. However, in the case of the section 54f, the proportionate amount will be taxable. Okay. CBDT clarifies that if the event of the death in the event of the death of the individual before the stipulated period, the unutilized amount is not chargeable to the tax in the hands of the legal heirs of the deceased individual. Section 54 as the extension of the time for acquiring new assets. Section 54H extension of the time for acquiring the new asset, where the transfer of the capital asset is by compulsory acquisition under any law, then the time limit for acquiring the new asset and for depositing in the capital gain CGS capital gain accounting scheme. Capital gain accounting scheme shall be computed from the date of the receipt of the compensation and not from the date of the compulsory acquisition. Example: Mr. BB purchased a gold in the previous year 2012-13 for rupees 13 crores on 16/3/2025. He sold such gold for rupees 40.05 crores. The transfer expenses is rupees 0.05 crores. On 28/6/25, he has purchased a residential house property in Mumbai for rupees 28 crores. He does not own more than one house property on the date of the transfer of the gold. On 30th March 2017, he has transferred the Mumbai house property for rupees 34 crores. Discuss the tax treatment. In this case, the full value of consideration. Full value of consideration is 14.05. Transfer expenses, cost of acquisition 13 crore. Exemption under section 54 of 27 lakh. Exemption कैसे? Long term capital gain into cost of the new asset, but it's restricted to 10 crore. Net consideration 40 crore. Net consideration rupees 40. Long term capital gain 27 into cost of the new asset, it is 28 crores. He does not own more than one. Net consideration is 40 crore. Net long term capital gain is 20.25. Now the computation of the capital gain on the transfer of the Mumbai house property. The full value of the consideration less transfer expenses, then the less cost of the acquisition. Cost of the asset, the deemed long term capital gain. deemed long-term capital gain as Mumbai property transfer within 3 years of the acquisition. Now the tax rates for capital gain, the tax rate for capital gain, the tax rate for capital gain, L section 112 A section 112 the tax on the capital gain, the tax on the long-term capital gain of the certain asset added by the Finance Act 2018 applicable for the assessment year 18 19 20 1920, the long-term capital gain on the transfer of the equity shares or the equity oriented units or the unit of the business trust in excess of rupees 1,25,000 shall be taxable. Section 112A, Section 112A, the tax on the long-term capital gain on the certain asset the added by the Finance Act 2018 applicable in the assessment year 1920. Now the long-term capital gain on the transfer of the equity shares or the equity oriented units or the units of the business trust in excess of the rupees in excess of rupees 1,25,000 shall be taxable. Rupees 100 for any transfer which takes place before 23rd July 2024 and 12.5% for any transfer which takes place on or after 23rd July 2024 in following conditions are satisfied. If following conditions are satisfied, STT paid on the acquisition or the transfer. If following conditions are STT paid on the acquisition and the transfer of the equity share, STT paid on the transfer of the equity oriented units and the units of the business trust now note the limit of rupees 1,25,000 shall apply to an aggregate of the value long term capital gain under the sub clauses A and B amended by the Finance Act 24 with effect from 23rd July 2024. The long-term capital gain arising from the transaction in the recognized stock exchange located in an international finance service center would be taxable at the rate 10%, 12.5%, where the consideration in the foreign currency, even though STT not paid in respect of such transaction. The reduction under Chapter 6A and the rebate under Section 87A not allowed against the capital gain report under Section 112A. Section 55 the cost of the acquisition in case of the equity shares or the unit of the equity oriented funds or the unit of the business trust acquired before 1 to 2018 and transferred on or after 1 to 2018 acquired before 1 to 2018 or transferred after on or after 1 4 2018, the cost of acquisition shall be higher of the steps 1 and 2 higher of the step 1 and 2 step 1 the cost of the acquisition and the lower of the fair market value and the sale value lower of the fair market value and the sale value lower of the fair market value and the same value, and it should be considered with the cost of the acquisition lower of the fair market value or the sale value, and then it should be considered with the cost of the acquisition. Note: indexation not available for computation of the capital gain under Section 112A. The indexation not available for computation of the capital gain under Section 112 with the computation of the fair market value as on 31st March 2018. As on 31st March 2018, the listed shares units on the recognized stock exchange on 31st January 2018. The fair market value highest price quoted on 31st Jan 2018. If no trading on 31st January, then the highest price of the last trading session before 31st Jan 2018. The unit shares not listed on 31st Jan 2018. In case of the units, fair market value is equals to net asset value on 31st January 2018, and in case of the shares not listed on 31st Jan 2018 but listed on the date of the transfer, the fair market value is equals to cost of acquisition into capitalization inflation into capital inflation index of the financial 1780, that is 272 upon the CII of the year in which the share was first held by the assessee for or 1 to whichever is later the equity oriented fund meanings The equity oriented fund, meaning the fund set up under the scheme of the mutual fund or the unit linked insurance policy, or to which the exemption under section 1010D does not apply, and deduction exemption under section 1010D, exemption under section 1010D does not apply in case where the funds invest in the units to the another fund which is traded on the recognized stock exchange. A minimum of 90% of the total proceed of such funds is invested in the units of such other fund, and such other fund also invest a minimum of 90% in its total proceeds in the equity shares or the domestic company listed on the recognized stock exchange, and in other case a minimum of 65% of the total proceeds of such fund is invested in the equity shares of the domestic company listed on the recognized stock exchange. Because in case where the funds invest in the units of the another fund which is traded on the recognized stock exchange, a minimum of 90% of the total proceed of such fund is invested in the units of such other funds, and such other funds also invest a minimum of 90% of its total proceeds in the equity shares of the domestic company listed on the recognized stock exchange, and in any other case the minimum of 65% of the total proceeds of such funds is invested in the equity shares of the domestic company listed on the recognized stock exchange. Now the funds invest 90% or more of the proceeds in the listed units to another funds invest 90% or more of the proceeds in the listed equity shares of the domestic company. The domestic company invest 65% or more of the proceeds in the listed equity shares of the domestic company. Section 111 A, tax on the short-term capital gain of the certain asset. Tax on the short-term capital gain on the certain asset. This is short-term capital gain on the transfer of the equity shares or the unit of the equity oriented fund or the unit of the business trust shall be taxable 15% for any transfer which takes the place before 23rd July, 15% for any transfer which takes place before 23rd July 2024, and 20% for the transfer which takes place after 23rd July 2024 if the short term capital, if the STT paid on the transfer of such asset, if the STT paid on such transfer of the such asset, if the STT paid on the transfer of such assets amended by the Finance Act 2024 with effect from 23rd July 2024, the concessional rate of 15%, 20% available on the transactions in the foreign currency on the recognized stock exchange located in the IFSC, even though STT not paid in respect of such translation deduction under Chapter 6, under Chapter 6A, under Chapter 6A, under section 6A not available against the short of capital gain under section 111 A tax on the capital gain on the certain asset 15% if before 23rd July 2024, and 20% if after 23rd July 2024. Now other capital gain tax other than the refund in 112A, 111A above. Now, if we see the transfer took place before 23rd July 2024, 20%, and the transfer took place on or after 23rd July 2024, 12.5%. The normal tax rates level, normal tax. Note: if the resident individual or the HUF transfers any immovable property acquired before 23rd July 2024 and the tax calculated on the long-term capital gain at the new rate 12.5% without indexation is higher than the tax calculated on the old rate, that is 20% with the indexation, if 12.5% without indexation, if 12.5% without indexation is higher, if 12.5% without indexation is higher than 20% with indexation, then the excess tax is ignored. In other words, the SSC is required to pay the tax 12.5% without indexation or 20% with indexation, whichever is lower. Now the proviso to section 112, the proviso to section 112, proviso to section 112, not applicable with effect, with effect assessment year 23rd July 2024. In case of the long-term capital gain on the listed securities other than the units or the zero coupon bonds, the assessee can pay tax 10% without indexation and 20% with indexation, whichever is low. 10% without indexation, 10% without indexation, 10% without indexation, and 20% with indexation. In case of the non-resident or the foreign company, 10% tax, 10% tax on the long-term capital gain from the unlisted securities or the shares without the first and the second proviso to section 48 is transferred if transfer took place before 23rd July 2024, and 12.5% if the transfer place on or after 23rd July 24. The benefits of the basic exemptions against the long-term capital gain: short-term capital gain 111A, long-term capital gain 112A. In case of the resident individual HUF, if balance total income other than the long-term capital gain 112, long-term capital gain 112A, and the short-term capital gain 111A is less than the basic exemption, then the unutilized basic exemptions can be used against the long-term capital gain 112A. Example: the total income, net taxable income of Mr. Ram is rupees 4,20,000. It includes the long-term capital gain on the sale of the land 2,50,000. Now the tax liability of Ram assumes he opted out from the default taxation regime. 115 PAC is equals to 2,50,000 minus 80,000, right? 80,000, which is equals to 1,70,000. Rebate under section 87 plus health and education says 4%. Rebate under section 87 minus rebate under section 87 and health and education says at the rate 4%. Now section 55A. Section 55A reference to the valuation officer. The AO refers the case to the valuation officer in the following circumstances: the fair market value claimed by the assessee as per the registered valuer. The AO is opinion that the value is so claimed is the variance with the fair market value. In any other case, the fair market value as per the AO opinion more than the value claimed by the assessee by 15% of the value claimed by the assessee, or 25,000, whichever is not the fair market value as per AO opinion more than the claimed by the assessee by 15% of the value claimed by the assessee. 15% value claimed, 15% of the value claimed by the assessee, or 25,000, whichever is lower, having regards to the nature of the asset and the other relevant circumstances. It is necessary so to do. Now section 2(1)(b) definition of the amalgamation: the merger of one or more companies with another company, or the merger of two or more companies from one company in such a manner that at least at all the asset and the liabilities of the amalgamating company becomes the asset and the liabilities of the amalgamated company. The shareholders holding 75% in the value of the shares in the amalgamating company becomes the shareholders of the amalgamated company. Now the taxations of the shareholders as per section 47. There will be no transfer and hence no capital gain when shareholders allotted the shares of the amalgamated company in exchange of the shares of the amalgamated company. The cost of the acquisition of the shares in the amalgamated company is equals to cost of acquisitions of the shares in the amalgamated company section 49 to now period of holding the period for which the shares held in the amalgamated company plus period of the amalgamated company period in the amalgamated company. Now the taxations of the amalgamating company as per section 47, there will be no capital gain on the transfer of the capital asset by amalgamating company to the amalgamated company. The taxations of the amalgamated company as per section 49(1), cost of the as per section 49(1), the cost of the acquisition of the asset becomes the property of the amalgamated company. The cost of the asset of the amalgamated company, the cost to the previous cost of the previous or the period of holding of the asset is equals to period of holding period of the amalgamating company as well as the amalgamated company. Section 2 clause 19A, demerger means the transfer by the demerged company by the demerged company of its one or more undertaking to another resulting company. All the following conditions are fulfilled: all the assets and the liabilities of the undertaking to transfer to the demerged company become the asset and the liabilities and the resulting company Tanishq Limited. All the assets and the liabilities should be transferred at the book value. Revaluation is to be ignored. Now the resulting company Tanishq Limited issues its shares to the shareholders of the demerged company Titan Limited on the proportionate basis, exempt when the resulting company itself is a shareholder of the demerged company. Now the shareholders holding minimum 75% of the value of the shares in the demerged company becomes the shareholder of the resulting company. Now the transfer of the undertaking on the going concern basis. Now the taxations of the shareholders section 47, there will be no capital gain in the hands of the shareholders of the demerged. There will be no capital gain in the hands of the shareholders of the demerged company when they receive the shares of the resulting company. The period of holding of the shares of the resulting company is equals to period for which the shares were held in the demerged. Also be considered section 2 clause 42A. Section 2 clause 42A, section 49 to C. Section 49 to C, the cost of the asset of the shares of the resulting company, the cost of the acquisition of the shares held in the demerged company into the net book value of the asset transferred in the demerger upon the net worth of the demerged company before the demerger. Net worth is equals to paid up share capital plus general reserve. Now section 49 2D D section 49 2D section 49 2D section 49 2D 49 2D, the cost of the acquisition of the shares in the demerged company. Section cost of the acquisition of the shares in the demerged company, the cost of the acquisition of the original shares in the demerged company, the cost of the acquisition of the shares in the resulting company. Point C. Now the taxations of the resulting the taxation of the resulting company, the cost of the acquisition of the assets received in the demerger is equals to cost of the asset of the demerged company. Now the taxations of the demerged company as per section 47, there will be no capital gain when the asset transferred by the demerged company to the resulting company. In case of the liquidation in the hands of the company, the distribution shall be treated as a deemed dividend under section 2 clause 22C. Now as per section 46(1), where the asset of the company is distributed on its liquidation, such distribution shall not be treated as a transfer. Hence the capital gain shall not apply in the hands of the company, in the hands of the shareholders, where the shareholders on the liquidation receives any money or other assets from the company, then the capital gain is applicable in the hands of the shareholder. Now the computation of the capital gain, money received minus the plus the fair market value of the asset received on the date of the distribution minus the amount assessed as the deemed dividend under section 2 clause 22C. Now the full value of consideration minus cost of acquisition, index cost of acquisition of the shares. Now period of holding of the shares, the date of the acquisition to the date of the liquidation. Then the capital gain is applicable in the hands of the shareholders in the year in which he receives the asset under the liquidation. The cost of the acquisition of the asset received under the liquidation is the fair market value of such asset on the date of the distribution. Section 55. Now the taxation in case of the buyback up to 30th September 2024. in case of the shares of the domestic company listed as well as unlisted in the hands of the company as per section 50 115Q, the domestic company shall pay the tax at the rate 23.296% on the distributed income which shall be calculated as under distribution income is equals to payback price minus the issue price including the premium note. The company required to pay tax within 14 days from the date of the distribution in hands of the shareholders. The amount received by the shareholders on the buyback of the shares shall be exempt under section 1034A. No tax treatment in the hands of the shareholder. The taxation in case of the buyback by the domestic company with effect 1st October 2024 in the hands of the company. There is no tax treatment in the hands of the company in the hands of the shareholders. Section 2 clause 22F. Any payment by the person by the company, any payment by the company on the buyback of the shares shall be treated as a deemed dividend in the hands of the shareholders, and it is taxable under the income from the other sources as per the normal tax rate. Now the buyback is treated as the extinguishment of the rights, so the capital gain is applicable as per section 46A in the hands of the shareholders. The computation of the capital gain full value of consideration always nil cost of the acquisition of the shares, the rate of the acquisition till the date of the buyback, period of holding till the acquisition, date of the acquisition till the date of the buyback. Example, Mr. BB acquired 1000 shares of BB Virtuals at the rate rupees 50 per shares during the previous year. BBVL buyback 300 shares at the rate 120 per share on 1/2/10/12/2020. Mr. BB sold 700 shares on 15/7/2025. 200 shares. Discuss the tax treatment in the hands of Mr. Baby. Now, during the previous year, 24 the 36,300 shares into rupees 123 as a deemed dividend in the hands of Mr. Baby under section 2 clause 22. It is taxable under income from the other sources. Now, the full value of consideration is this minus cost of acquisition of the shares, cost of acquisitions of the computation of the capital gain for the 700 shares is equals to full value of consideration. Cost of the acquisition of the shares is this. Long term capital gain. Long term capital is loss of the last year. Let's just end this session as I have completed this chapter. Bye bye.